Most people believe their money is safe the moment it enters a bank. They trust the logo on the door, the insurance label, and the promise that their savings will always be there when they need them. But history shows us something very different. In every major financial crisis, the rules change fast and without warning. Here is a truth few people are told. When you deposit money into a bank, it stops being your money in a legal sense. The bank becomes the owner and you become a lender. Your account balance is not cash in a vault. It is a claim. And that makes you an unsecured creditor. This distinction matters more than most people realize. In 2010, after the global financial crisis, the United States quietly changed how bank failures would be handled. Politicians promised taxpayers would never again be forced to rescue banks. Instead of bailouts, a new system was created, bail-ins. Under this framework, banks would survive crises by using the money of their creditors, including depositors. If this sounds theoretical, it isn't. In 2013, the European country of Cyprus became the first real-world test. One Friday, banks were open as usual. Deposits were untouched. By the following Tuesday, nearly half of large account balances had vanished. The government had legalized the seizure of deposits over the weekend. Businesses collapsed overnight. Retirements disappeared. And it was all done within the law. Many Americans assumed this could never happen in the United States. But the legal structure already exists. Under the Dodd-Frank Act, the FDIC has the authority to take over failing banks and restructure them during a crisis. That restructuring can include converting deposits above the insured limit into equity, stock in a struggling institution. FDIC insurance covers up to $250,000 per depositor per bank. On paper, that sounds reassuring. But the FDIC insurance fund holds only a fraction of total U.S. deposits. In a widespread banking failure, it would be exhausted almost immediately. At that point, regulators face a choice: massive money printing, political chaos, or bail-ins. Bail-ins are fast. They don't require Congress. They don't increase visible government debt. And they are already built into bank resolution plans. Imagine a future crisis triggered by commercial real estate debt, rising defaults, and pressure on regional banks. Over a single weekend, accounts are restructured. Small depositors are protected. Large balances are not. The bank reopens, stabilized by depositor money. Nothing illegal. Nothing unexpected, at least not for regulators. This is not a conspiracy theory. It is documented policy. It appears in regulatory papers, international agreements, and official bank living wills. The reason most people don't know about it is simple. No one talks about it. The system is designed to function quietly, until it suddenly doesn't. And when that moment arrives, understanding how money truly works inside a bank may matter more than anything else. So the real question becomes this: what can you actually do? Knowing the risk is one thing. Acting on it is what matters. 1. Understand your real exposure. Start with the basics. How much money do you actually hold inside banks? Not investments. Not real estate. Real cash balances. If any single account holds more than $250,000 at one institution, the excess is exposed to bail-in risk. But even staying under the FDIC limit doesn't make you invincible. In a systemic crisis, the insurance fund itself may not be enough. And even if it works, access to your money could be delayed for weeks or months. Liquidity matters just as much as protection. 2. Spread deposits across multiple banks. Concentration is risk. If you have $500,000, keeping it all in one bank is unnecessary exposure. Split it, $250,000 in one bank, $250,000 in another. But be careful, different branches of the same bank don't count. The FDIC limit applies per institution, not per location. Make sure the banks are truly independent of one another. 3. Consider stepping outside the banking system. Banks are not the only place to store capital. Treasury bills purchased directly through Treasury Direct are backed by the U.S. government and sit outside the commercial banking system. Treasury money market funds offer similar safety and liquidity through brokerage accounts. These assets cannot be bailed in because they are not bank liabilities. In a crisis, they remain yours untouched. 4. Reduce excess cash exposure altogether. Cash is vulnerable from both directions. Bail-ins on one side, inflation on the other. Beyond emergency needs, excess cash loses purchasing power and creates unnecessary system risk. Physical gold and silver are not bank assets. They are not promises from anyone else. They cannot be frozen, converted, or restructured. Real estate offers similar protection. It cannot be seized in a bail-in and retains intrinsic value. Stocks held in brokerage accounts are also outside the banking system. The goal is simple: move long-term capital out of vulnerable containers. 5. Business owners must be especially cautious. Operating accounts are prime bail-in targets. Payroll funds, vendor payments, reserves, all often exceed FDIC limits. Only keep what you truly need for short-term operations inside business bank accounts. Move reserves into treasury instruments or government-only money market funds. Some businesses spread cash across multiple banks, which helps, but does not eliminate systemic risk or access delays during crisis conditions. 6. Learn the early warning signs and act fast. Bank failures rarely come without signals. Collapsing bank stocks, rising credit default swap prices, emergency press conferences, negative headlines multiplying overnight. When you see these signs, speed is everything. Bail-ins happen over weekends. Waiting for confirmation is how people get trapped. Those who move early protect their capital. Those who hesitate lose control. 7. Expect restrictions once crisis begins. During financial emergencies, governments don't rely on market goodwill. They impose controls, withdrawal limits, transfer restrictions, temporary bank closures. Cyprus proved this. Once capital controls appear, options disappear. Protection must be proactive, not reactive. 8. Never assume your bank is safe. Strong today does not mean stable tomorrow. Silicon Valley Bank collapsed in days. In modern finance, confidence moves faster than balance sheets. Even solvent banks can fail under panic. Fear creates bank runs and runs destroy banks. 9. Educate the people connected to your money. Spouses, business partners, family members. Anyone sharing financial exposure must understand the risk. Silence helps no one. Awareness is not alarmism, it's preparation. 10. Monitor your accounts closely. Crises create chaos. Errors happen. Funds move incorrectly. Monitoring isn't paranoia, it's discipline. In unstable systems, attention is protection. Now let's address the objections because they always come. The government wouldn't allow this. They already have. Cyprus proved it. The legal tools exist here as well. FDIC insurance will save me. Maybe if the crisis is small, the fund holds and you can wait. My bank is too big to fail. So were others until they weren't. This is fear-mongering. No. This is documented policy, historical precedent, and legal reality. I don't have enough money to worry about this. Access matters. Even temporary loss of cash can collapse daily life. Let me be clear, banks are necessary. They're tools, not safes. Use them for transactions, not for long-term storage. Keep what you need close. Move what you can protect elsewhere. That isn't extreme. It's simply prudent given the system we're actually living in. Now let me walk you through what a bail-in might actually look like, not as a legal definition, not as an academic scenario, but as a moment people live through in real time. It's a Friday in late 2026. The market opens like any other day, but by mid-morning the headlines start to shift. A large regional bank announces unexpected losses tied to commercial real estate. Office buildings that once generated steady income no longer do. Vacancy rates are high. Refinancing failed. The losses are big enough that analysts immediately downgrade the bank. Its stock begins to fall fast. At first, most people don't react. Then the story spreads. Financial news channels bring on experts. Social media fills with speculation. By noon, nervous customers start checking their balances. By early afternoon, that nervousness turns into movement. Lines form outside branches. ATMs begin to run short on cash. Some stop working entirely. Mobile banking apps lag or freeze. Transfer requests fail. Screenshots flood social media. Rumors accelerate faster than facts. By the end of the day, confidence is gone. As the weekend begins, regulators step in quietly. Using emergency authority granted under Dodd-Frank, the FDIC takes control of the bank. Trading is halted. Accounts are frozen. A brief statement assures the public that a resolution process is underway and that customers should remain calm. No further details are provided. Behind the scenes, the decision is made. The bank will be saved using a bail-in. When Monday morning arrives, the bank reopens. A polished press release announces success. The restructuring is complete. The institution is now stable. Deposits are protected. The crisis, officials say, has been contained. Then people log in. Balances have changed. Anyone with deposits above $250,000 sees money missing. That missing amount wasn't stolen, frozen, or misplaced. It was converted. Depositors are now shareholders in a newly restructured bank. They didn't choose this. They weren't asked. It simply happened. The stock they received trades at a fraction of the value of what was taken. For business owners, the impact is immediate. Payroll accounts are suddenly short. Employees aren't paid. Vendors can't be funded. Cash that was supposed to be there Monday morning is gone, replaced by illiquid shares no one wants. Retirees are hit just as hard. Certificates of deposit and life savings that were meant to provide stability now sit partially confiscated. The income they relied on disappears overnight. Panic doesn't stop at one bank. Customers at other regional banks begin rushing to withdraw funds. Each withdrawal accelerates the next. Liquidity tightens. Additional institutions show stress. One bail-in quickly becomes several. The crisis spreads. Government officials appear on television urging calm. They say the financial system remains strong. They repeat that deposits are safe. They insist everything is under control. But something fundamental has already broken. Trust. People now understand what they didn't before. Deposits are not untouchable. Bail-ins are real. And once depositors see it happen with their own eyes, confidence never fully returns. This scenario isn't imaginary. It's based on documented precedent and existing law. Cyprus followed this script almost line by line. The US legal framework allows the same outcome. The most unsettling part is how sudden it feels. There is no countdown. No formal warning. One day your money is accessible. The next day it isn't. The people who come through this intact won't be the lucky ones. They'll be the ones who prepared long before the headlines appeared, the ones who understood how the system actually works. So the question becomes unavoidable. Which group will you be in? Those who acted early or those who assumed someone else would protect them? The information isn't hidden. The laws are public. The warning signs are visible. By the time the crisis is obvious, it's already too late. And this isn't only an American problem. In 2014, G20 nations agreed that bail-ins would become the standard global solution for bank failures. Europe adopted them. Canada implemented them. Australia followed. Wherever modern banking exists, bail-in risk exists. Moving money to another country doesn't eliminate the danger. The only meaningful protection is moving wealth outside the banking system, into assets that cannot be converted, frozen, or restructured by a failing institution. Physical precious metals. Real estate. Stocks held at brokerages. Treasury securities issued directly by governments. That leads to an obvious question. Why don't politicians stop this? Because politically, bail-ins are easier than bailouts. After 2008, voters made it clear they would not tolerate taxpayer-funded rescues. Bail-ins shift the pain quietly to depositors instead. Many lawmakers don't fully understand the mechanism themselves. The critical language was buried deep inside technical sections of Dodd-Frank. And most elected officials don't hold large cash balances anyway. Their wealth is tied up in assets, stocks, properties, businesses, all largely insulated from bail-ins. They are protected. Ordinary depositors are not. That's why relying on the political system for protection is a mistake. The incentives are wrong. The motivation isn't there. Your financial safety is your responsibility. And the window to act is not unlimited.